value-added tax is one of transactions taxes, which is levied on the supply of goods and services other than those items that are exempted from VAT. Now, when we are talking about value-added tax, we'll be looking at it from the perspective of both input VAT and output VAT. And we know that in Nigeria, the acts that regulate our value-added that provide uh, provide us with how we can account for value-added and what exactly we need to know about it is the value-added tax acts, value-added tax act, and the rates of our value-added at 7.5% is at 7.5%. Now, I will be taking this our value-added from two angles. We have input VATs, and then we also have output VATs. What input VAT relates to is on purchase of goods, or when we also enjoy some services. So when some maybe consultants provide us with some services, they are value-added. That is if such transaction or if such item that we purchase attracts VAT, or we also say that such items are VATable. Why our output VAT relates to our sales of goods or provision of services to the third parties. Now, in our Value-Added Tax Act, it is provided in the act that if the item that we purchase there is for resale, if it is for resale, that is when we can claim this. This one is claimable. But if it is just for maybe for OPEX or CAPEX, so this is not going to be separated. We are not going to separate that VAT portion on our invoice. We are not going to separate it. We are going to add everything to either our OPEX transaction or our CAPEX transaction. So the effect of this VAT input on our VAT output is if we are reselling an item. If maybe, let's assume that we purchase some raw materials as part of our item that we use in producing our finished products, and there is an element of VAT on such item, that is when we can be having VAT input. That's when at the point of recording it, we can now separate VAT output from the actual cost of goods. Then for the sales of our goods, so this one, we are collecting this one on behalf of the government. But if the item that we are selling, is does not attract VAT, we cannot say that we want to claim any VAT on it. Now, in order to really appreciate this and to also have a better understanding, we'll be taking the scenario on the screen. We have this ABC company, a retail business, purchased inventory and incur other expenses during the months of January 2000XX. The following transactions took place. On January 5th, ABC company purchased inventory worth 10 million naira, exclusive of VAT from XYZ supplier. Then, if you are to get an invoice from our supplier, this is the total amount that is going to be on the invoice. So now we have invoice from invoice from XYZ supplier. So on the invoice, they are going to separate it like this. We have inventory, inventory purchased, inventory purchased, 10 million naira, while the VAT at 7.5%. That will be 750,000 naira. Then we have 10 million, 750,000. For scenario 2 now, on January 15, ABC company purchased a computer for office use from Tech Solutions. Since this item is for office use, this is capex. It relates to capital expenditure. So this is for office use. We are not reselling it. Because what I'm trying to emphasize on this is that the accounting, this either we are reselling or we are using it, will have effect on how we are going to account for it. Then we have invoice from Tech Solutions. So this is what the Tech Solutions will also use in their invoice. Computer purchased. Let's say supply of computer. Computer, 2 million naira. Then they also put VAT on it. VAT at 7.5%. That is 150,000. Then we have 2,150,000. For scenario 3 now, on January 28th, ABC sold goods to customer for 17.5, inclusive of VAT. Now, why I also bring this one is that because in some instance, we can have some invoices that may be VAT inclusive, which means that that invoice is already inclusive of VAT. So it's not that maybe we are separating the VAT. But for the purpose of us to have a proper accounting for it, it means that we need to separate the VAT element from this. So what we have here is that this 17.5 is at 107.5%. And we need to separate it. We need to separate because since we have a VAT element here, the VAT element is for the government. We are not the owner. It is not the company that owns it. Now we can now have scenario 3. We have total invoice is 17.5. Then for the revenue portion, that will now be 17.5 divided by 107.5 times 100. 17.5 divided by 107.5 times 100. So we have here 16,279,070. Then for the VAT on this VAT element, this is input VAT. This is also input VAT. Why this is output? Because we have made a sale. Output VAT 17.5 minus 16,279,070. So the VAT on this is 1,220,930. For scenario 4 now, for scenario 4, On January on January 23rd, ABC company received an invoice for legal fees totaling 1.3 million naira, excluding VAT. The company made the payment for the invoice on the same day. Now, what we are going to have here is that legal fees, that is, by the time the lawyer will also provide his own invoice, the legal fees, we have 1.2, 1.3 million, then we have VAT at 7.5%. This is 97,500. So the total invoice that the barrister or the solicitor will provide now is this 191,397,500. Now, so having identified our VAT inputs and our VAT outputs, so let us now look at the accounting entries. So this is the main issue. This is the main issue for some people. So we have ledger posting, we have debits, then we have credits, right? Now for our invoice one, for the invoice that was received from XYZ supplier. So what we have here is the total amount, this is an inventory, and our inventory is an asset, right? Inventory is an asset. So we are not going to take the whole 10,750 to inventory because this item is for resale. It's for resale. So what we have here is that we have inventory purchased 10 million. Then VAT, because we are going to recover this VAT, either we call it VAT receivable or we call it VAT output. This is 750,000. Then we now have bank or payable. So depending on whether we are paid or we are still in, this would be 10 million, 750,000. For the second case study, invoice from tech solution, this item is not for resale. So, and what our VAT law provides is that the provision of our VAT Act is when an item that when you purchase an item that will go through either the POL or capital expenditure, such VAT should be added together. So for this one, we have computer equipment. Two 150. Why we have bank or pay 150. For the third scenario now, we have this, we have receivables or bank, that is our trade receivables or bank. 17.5 is already inclusive of VAT. Then we now have VAT payable or we have VAT payable or VAT inputs. This will be 1,220,930. And then we also have revenue 16,279,070. Then for the fourth one, so this is a legal service that the company has enjoyed. So there is no point of also separating VAT. So what we just have here is that we have professional fee, professional stroke legal fee, 1,397,500. Then we have either bank, okay, because it has been identified that the company paying on the same thing, 1,397,500. 1,397,500. 1,397,500. So this is how to actually account for our VAT. So whenever we have, whether we have some transactions that involve with sales of goods that we purchase, or it's just only for the business activities, such as capex or a opex transaction. So this is how we are going to account for it. So I hope that with this little explanation, I've actually been able to convince and not confuse. So if you find this uh, video valuable, kindly subscribe to our YouTube channel so that uh, whenever we drop another video, you'll be able to get a notification in time. Till we meet on our next class, I want you to learn, relearn, and unlearn so that if you have any question, do not hesitate to reach out. Thank you.